So thank you for joining me here to discuss not just the influence that the EU legislation will have on Switzerland, but also to discuss where we stand in Switzerland today. And let me introduce the panelists to you first. To my left, we have Claudia Emele. She's the CEO of Avadis Anlagestiftung and the CIO of Avadis Vorsorge AG. And prior to that, she was Managing Director of Ortec Finance and also an Executive Board member at Complementa. So she dealt with investment strategies at pension funds for many years and now works for many pension funds in her role. In the middle, we have Markus Fuchs. He's the Managing Director of SFAMA, the Swiss Fund and Asset Management Association. He's been its director since 2013 and held other roles with the same organization previously. And before that, he worked in UBS Global Wealth Management, where he was responsible for hedge fund products, actually, and previously worked for Swiss Life Funds. So a lot of fund experience collected here in his person. We then have Pascal Zbinden. He's co-head SAA and Markets at Swiss Re, so working in the investment arm of Swiss Re within Swiss Re Group Asset Management. And he's a member of the Asset Management Executive Team. Within his function, he is co-leading the Strategic Asset Allocation, that's what SAA stands for, and Markets Unit with direct management responsibility for listed equity, credit, securitized products, and other areas. Prior to this, he held several other roles in Swiss Re Asset Management and also was the right hand of the CIO for many years. We already heard a lot about the role of Sven Gentner. And to dive into it, I would want to start with my Swiss panelists and start with the one who is investing on behalf of Swiss asset owners, mainly on behalf of Swiss pension funds, as I understand. Claudia, Avadis Anlagestiftung is an organization investing on behalf, I think, over 100 pension funds and has total assets of about 10 billion Swiss francs. And on your website, I scrolled through it, you actually mentioned that you also consider ESG factors in your investments. You're also one of our more recent members, actually, one of the 5 asset owner members that I mentioned during the morning that joined us in the past year. And you also say that you integrate this across different asset classes. So how do you actually do it in the different asset classes? And I now hand over to you this microphone.
Okay. So basically, to understand how Avadis works, like the main asset classes such as equities and bonds, we choose external managers to manage these assets for us. When choosing these managers, we implement a best-in-class approach. One of the criteria when we choose managers is also how they do on ESG. And all of our external asset managers we have chosen, they are signatories of the UNPRI. They integrate ESG factors in their investment approach and in their investment decisions. So, for instance, for our Swiss bond manager, the Swiss bond manager uses ESG ratings to choose the right bonds and to filter the better issuers from worse issuers. And about the same, like integration in ESG is done by our equity managers on the active space. On the passive space, we have most of our assets invested in equity. In passive, we have full replication. We follow traditional MSCI indices, but currently we discuss widely whether to switch to ESG indices or whether to keep the traditional indices but implement carbon dioxide reduction strategy. Last but not least, we also manage assets in-house, which are real estate assets. For this, we have 3 billion assets under management. For a long time, we consider ESG criteria there, be it like sustainability of where we buy this building, the materials we use when we refurbish them, and also like energy efficiency, for instance, to reduce fossil heating systems and switch to more green ones.
Thank you for these insights. Yes, we now have sound on this microphone as well. So thank you for the insights. I think we can dig a bit deeper later on. I would now like to switch to Pascal Zbinden. It was about 2 years ago that Swiss Re announced to fully switch to sustainable benchmarks for their asset management. And I believe the majority of your assets you have managed by external providers. I think it cost quite some attention, this step. Now, this is 2 years back. What were your experiences with it?
Yeah, so we were very happy about the attention. I think it was intentional. I think for us, it wasn't that much of a new topic. I think we had sustainability as a big topic for the company and also on the investment side for a long time. We were one of the early signatories on the PRI side. But a few years ago, we sort of rethought our strategy and thought, we've been doing some exclusions for a long time. We started to do what we call inclusion, which others maybe call thematic investments, which go into green bonds, doing infrastructure debt investments with a focus on renewables. But that still leaves a big chunk of the portfolio as sort of not addressed. So what do you do with that? So we decided to do the switch to ESG benchmarks, which are essentially best-in-class benchmarks. So to give you a sense, it's relevant for equities and corporate bonds in particular. On the equity side, you remove 50% of the investment universe. So it's a significant change, significant starting position for our external managers, which also I would echo what was said before, where we put a core focus as well on the selection process in terms of their own ESG processes to make sure that we really get that. I think the benchmark is a starting point. So you may ask, why do we do that? Well, we really think it makes economic sense to do that beyond the sustainability aspect. What do I mean by that? What I mean is, if you look at the return of these benchmarks, it's very comparable to the broader benchmarks. So I think the perception that it's either return or integration of ESG, we didn't really find that. But that wasn't really the fascinating revelation for us. What was more important, or I think the key point for us was actually, if you look at the volatility of returns of these ESG benchmarks, is significantly lower than the broader benchmark. So if you look at the risk-adjusted return over the long term, so we're long-term investors with long-term businesses on our insurance side, over the long term, you see a higher risk-adjusted return. And that's obviously very, very attractive for any investor.
And if I'm not mistaken, a majority of your portfolio is actually in bonds.
Correct. As an insurance company, we have an interest rate risk from future cash flows on the insurance side that we want to match. So our portfolio is 80% in bonds, 10% usually around cash, and 10% in other asset classes, equities, real estate, private equity.
Mm-hmm. So even on the bond side, you can say better risk-return profile.
Absolutely, and I would say actually the case was even stronger for corporate bonds than for equities, where equities globally, we saw clear evidence, but I think you see more differentiation between the submarkets versus corporate bonds. I think we saw a very, very strong case.
Mm-hmm. Quite impressive, I would say, and probably a role model, hopefully, for other Swiss institutional asset owners. Now I would like to move on to SFAMA. Your organization unites 189 members. Not all of them are asset managers, but a majority of them are managing assets themselves. And your organization has as its main objective to work towards beneficial frameworks for the fund industry. And I remember when we met first time over lunch, what you told me is, well, sustainability is not really important. What is important is that we have market access in Switzerland. We, as SFAMA, we just work towards market access. So sustainability wasn't really part of your objectives. Now, you approached us at the beginning of this year or at the end of last year and suggested, why don't we cooperate on establishing guidelines for sustainable asset management? What made you change your mind, Markus?
Yeah, actually, Sabine, you gave me two questions. One is why it took so long to take sustainability on our agenda, and the second one, why we teamed up. The first one is a little bit simplified. Let's say asset management is a rather, banking and financial services in general, a rather traditional industry. And the focus was usually on who beats whom, benchmarks and active and passive, and should we invest more in bonds and equities. And that led to a situation where we use language which nobody understands. It's not understandable. We always talk to ourselves. Now, we really were thinking hard, what's the case for asset management, what's the purpose for asset management, and then we came to the key drivers of our industry. And the key drivers are not regulation, it's not technology, it's not globalization. The key drivers are longevity, and herewith the financing of the social security systems, that's one element. And the second element is to finance the infrastructure in various countries. That said, financing infrastructure in various countries, as well as financing social securities, are very long-term oriented activities, and you cannot handle them without integrating ESG criteria. And that's then very clear that sustainability must be one key element next to longevity, next to financing infrastructure that has to be on our agenda. Second thing, of course, and your president mentioned it initially, Swiss Sustainable Finance stands for sustainability, irrespective whether there's a bank or an insurance company or an asset management or anything behind it. And SFAMA take the same approach. We stand for asset management, irrespective whether an asset management service is provided by a bank, an insurance company, or a pure asset manager. And that's why we were thinking joining forces for an area where we call sustainable asset management. And sustainable asset management is the key element, and it needs to be in a framework that our members and your members can, by the way, majority is the same, that all the asset managers can understand, and so we can give them guidelines in order to understand sustainability and to help them to implement sustainability criteria, which is not always the case, by the way. We still see the big companies who are very much progressed. However, many smaller asset managers are simply not there where we wish they were.
So we have to say maybe we aim these guidelines to address not really the overlapping part of our organizations, but maybe your members that are not yet part of SSF. But let's hope it also provides some useful information for SSF members. Now, Sven, you talked to us and impressively showed the broad variety of initiatives that the EU took on a regulatory level to actually promote sustainable finance. You gave us this concise overview. We read about some comments, but tell us, what were the aspects that caused the hottest debate so far?
Maybe personally, the most severe experience was the last round of negotiations of this disclosure regulation, which started at 3 o'clock in the afternoon in the European Parliament and finished at 6 o'clock the next morning. And then it was done, but that's a personal reflection. But overall, of course, all these negotiations are difficult because it is important what is being negotiated. First of all, it is important what we want to achieve. We have to stop climate change, because if not, things are going to go really badly. But of course, all of this affects not just the financial industry, but it affects the real economy. It affects producers of cement as much as energy production, as building companies, and whatever. So of course, there are lots of interests at stake. In the European Union, we have a very inclusive, very open regulatory process. We had several rounds of consultation. You have all the member states involved. You have the European Parliament involved. Everyone comes with their views to the table, but what I found impressive is that nevertheless, in such a very short amount of time, we were able to reach agreement on 2 out of the 3 legislative initiatives. Difficult, requiring late-night action sometimes, but could be done. And there is an overall, I think, willingness to move there. On the taxonomy, negotiations are ongoing because maybe also because of the technical aspect of this. This is a very, very complicated, detailed undertaking. I really encourage you all to have a look at the reports that were published. I find them very impressive. I was not personally involved in the production, so I can say this, but I think they were really well done. I mean, we had a large group of stakeholders involved. We had several hundred really technical people contributing to this. The report of the taxonomy that is on the website runs to several hundred pages and goes through industry, activity by activity, sector by sector, and explains very clearly which activity is sustainable, which is not, what is in, what is out, very transparent. And of course, this is a difficult exercise. It is something that will have a huge effect in an indirect way through information processing and all that. But I think we can get there, and as I said, 2/3 of the legislative package are agreed already.
It's impressive, we have to admit. I think we can dive a bit deeper with the taxonomy a bit later on in the discussion. I would now like to focus on fiduciary duty. You explained that you have really firmly anchored it in different legislations, addressing different players. In Switzerland, we somehow get conflicting signals on the question if sustainability is actually part of the fiduciary duty or not. Some players tell me, well, that's no longer a question, it's decided, it's clear. And then we get signals from some federal authorities still saying, well, climate change is not part of the fiduciary duty, which of course sends quite conflicting signals. I'd like to address mainly the asset owners here. How do you think, what do you think the situation is like in Switzerland? Is this debate over, or do we still have to clarify if it makes sense for an investor to take climate change as one sustainability aspect into account? What do you hear from your pension funds, from your clients?
I think there is a lot of... I think there is a lot of confusion still of whether to integrate it or not. A lot of them think it's something that really is integrated into the fiduciary duty concept, and a lot of others are still not yet convinced. They say the most important aspect of fiduciary duty is manage the pension assets thoroughly, and they're not really convinced that investing in a sustainable way creates value. So they have made maybe in 20 years ago, when the first sustainable concepts came up, they invested and they lost money. And this already left maybe negative signs, but a lot of them are progressive and would like to integrate it. So basically, to come back to your question, we have a lot of discussions with clients, and we have, as Sabine mentioned, over 100 clients. So a lot of them want to do something, take actions, but they do not yet know where to start. Should they change the benchmark, switch to sustainable benchmarks? Should they do a thematic approach, invest in climate products? So they discuss with us, what shall I do? I want to do something. It's my fiduciary duty. I'm not 100% sure. So we discuss a lot, but pension funds are not really enthusiastic to take actions.
Pascal, what is your opinion? Fiduciary duty, are we at the end of the debate?
I would hope so. But since you raised the question, probably not yet. And I think it probably links back to what we had in the market studies. Why do not more investors adopt ESG generally, independent of fiduciary duty or not? Is, I think, still that perception that it costs returns. I think that's where the debate started, right? It's, you have a fiduciary duty to provide a financial return to your pension plan members or whatever other clients you have. And so you cannot do both at the same time. And again, based on our studies and other studies, I would say that's not the case, particularly over the long term, which I think is probably where most of the question lies as well. It's, the long-term savings products, right? So I wouldn't say one goes without the other. And the other aspect is, I think, the duty of care. Clearly, you need to continue to have, basic risk management principles. You don't want to invest into just one green investment, as one extreme example, right? So I think, but again, I don't see, significant issues not to have the ability to build a portfolio that incorporates sustainability. And we talked a lot about climate change, right? Climate change does affect financial value of assets. Maybe not yet today, unfortunately. but certainly over time. And I think the adaptability of company on that journey is very important. So it's also about, really understanding the companies you invest in, and that's at the core, I think, of fiduciary duty.
Comment on the right.
Sorry, maybe just one word. I think it's also basically an overall process where we as a society were reassessing the risks that we're faced with. And the financial sector is part of this. And maybe things that a few years ago we thought is not such a big issue has simply become a very big issue. And as in every process in society, personally or whatever, it takes time to get your head around this. It takes time to fully understand the extent of it. And I think all of what we're doing now, in a sense, is part of this development, to make sure that everyone understands that these are real risks. It's not some kind of nice-to-have green initiative and whatever. We're talking about real things that affect real people, real economies, that will have an effect on everyone here. And I think all of this, what we're doing in the industry as a regulator, helps push this process along, because what we've realized also is that we're too slow. We're quite simply too slow, and we need to accelerate.
I would fully agree with all you've said. Sometimes I have the impression that we do not answer the same, that we answer the same question in a completely different way. Of course, fiduciary duty includes having a kind of a strong and robust risk management process in place, and such a process must include sustainability risk. This is something which might be new, for instance, and you mentioned it right. Some companies do not know how. And if you look at let's say the investment process a couple of years ago, the key criteria to invest in a company were strong balance sheet, good quality of management, profit expectations, solid business model, and sustainability was nowhere. But today sustainability is a key element in order to prove that you have a sustainable business model. And from that point of view, I would say we are all aligned.
Well, we heard from the president of the Swiss Confederation earlier on that the market follows or that finance follows the market, and it depends on the frameworks that you give to the real economy. In Switzerland, we often or usually build on the subsidiarity principle for legislation. So let the market act first, and then only act when the market isn't fast enough. If we now listen to what happens in the EU, we may raise the question, does this subsidiarity principle in Switzerland still work? Are we fast enough to follow what happens in the EU? Will we stay competitive? What do you think?
Well, I'm asked this question about 5 times a day, and it's not just in the area of sustainability, it's everywhere if you think about the institutional framework agreement with everything. And we must clearly see that the standards today are more and more set by international standard-setting organizations such as OECD, G20, and many others. And if you want it or not, we are in the heart of Europe, and in a material way, we usually follow the European legislation in a material way. And yes, we are rather a follower than shaping the whole thing actively. And a follow-up question would be, why do you follow Brussels and don't have a stronger look in the faster developing Asian markets or Latin American markets? And also this answer is to me very clear. If you look at the 3 blocks globally, US, Europe, Asia, there we have US, and in the US it's pretty simple. You have to follow their rules. It's a take it or leave it approach. It's nothing about equivalence principles. Asia, there's no such thing as Asia, but what we know for sure is that the Asian countries, at least the more developed ones, follow the European approach. They have an equivalency regime in Singapore, Hong Kong, and many other countries. And for us, it's clear we have to implement international standards, and because we are in the heart of Europe, it's probably the easiest way to cooperate with Brussels as good as it gets, accepting the internal difficulties we have on the political side.
So definitely still some room for dialogue on this end. But let's talk a bit more about the different elements of the action plan and the legislation that you presented. Quite a lot of what you presented actually relates to transparency. But does more transparency automatically lead to more sustainability?
I think it's a necessary first step. We were told also by the industry in the consultations that we conducted that more standardization, more readily available information is needed, that more clarity needs to be there about what is green, what is sustainable, what is not, because it helps the functioning of the market. Markets can only function if the information is available. So in that sense, I think this will already create pressure and redirect investment. But the question, of course, is will it be enough? And that is something to be watched. But of course, what we do in financial market, and I tried to explain this in the beginning, does not stand alone. We already have regulation also on economic activities themselves, production of cars, energy production, building codes, etc., which will require a lot of investment to be made over the next years. So what we need the financial market to do is basically to provide the money for that. So what we try to do with the action plan is through more information, through better transparency, through different incentives to kind of help that the financial market can play this role. But of course, and I don't think I predict too much, will be something that will be watched also over the next few years, where I'm quite sure we'll see additional steps taken, quite simply because the problem is such a big one.
Mm-hmm. So what are the opinions from other voices?
I think like per se transparency does not necessarily lead to more sustainable investments, but what is surely true is the more transparency you have in what you can invest and how benchmarks are, compositions are, the more the investors and pension funds can rely on what to do, and maybe also the distinction between what is more elaborated and what is better investments than the worst one, or when you introduced like other concepts like global investment performance standard, this also helped to distinguish like the bad guys from the good guys. And I think like this will be a similar thing for investors. They can rely on transparent decisions that helps to make markets more professional, and more professional markets lead to better decisions at the end.
Pascal, was lack of transparency a problem for you so far?
I would say yes and no. So I think there's a lot of data, and I think the probably other aspect is, each investor, I think, needs to probably go through a bit of a journey of what you want to actually try to achieve, right? And I think this transparency is one, what is the company's activities, how does it fit the taxonomy, but the other is actually, what are the type of options that you have. So for sure, I think there's a lot of capital probably waiting on the sidelines because it's confused, around the lack of standards, threat of methodology, and that will, I think, taxonomy and other aspects such as labels, I think will unlock a lot of that. From an investor point of view, I think what's really relevant is not just transparency, it's actually relevant information, right? So I think that's where I find it very, very important that it's the private sector and the public sector that work jointly together to define what's really relevant information. What should company assess more in terms of risks, what should they disclose. I was very happy to see that some of the communication yesterday built on the TCFD, for example, right, which for me is a good example of actually, despite maybe pressure, something that was established by a working group that was joined between public and private sector, and that can now be leveraged, right? But I think ultimately for investors, it's important if you want to unlock this also for large institutional investors to really provide meaningful information and not just, check boxes. So I think transparency, yes, but also relevance and accuracy.
So in that sense, it's definitely important that the EU now also integrated the TCFD recommendations in the disclosure regulation. I would like to drill down a bit into the taxonomy. The report was published yesterday. There was a comment already in RI, a rather critical comment from one of the market players providing information on sustainability and climate alignment of companies, saying the activities you describe in the taxonomy relates to about 1% of market activity out there, of industrial activity. Now stating that this 1% of the economic activity is the sustainable part of the economy, and encouraging all investors to go into this 1%, do you not just create a bubble with it?
I mean, if you look what has been published, the taxonomy is not just about identifying the purest of the pure, because that would not work, because then we're in a niche and it's not going to help the transition of basically the whole of the economy that we need. What the taxonomy does, it identifies purely green activities, climate neutral, whatever, but it also identifies how to green the brown. So in a sense, if you look at things like, I don't know, cement production, there are different ways of how you can produce cement. More energy intensive, less energy intensive, with more CO2 emissions, with less CO2 emissions. So in the taxonomy, and as I said, all of this is publicly available, you have all these listed and said, okay, if the activity is below a certain threshold, it qualifies. If it is above the threshold, it does not qualify. These are technical assessments, and these technical assessments will, of course, also change over time. So in a sense, the screw, based on technical considerations, will slowly be tightened. But it does not mean that it's a cement production is CO2 intensive, that's why it can never be taxonomy compliant. No, it's something which is necessary, but we have to use the technique, the technology which is the least environmentally intrusive, the least CO2 emitting. And so that's what this whole framework tries to do. We need to help the transition towards a more sustainable economy.
I would say a lot of sustainable investors in this room would argue that with the products they have had on the market so far, they were more working towards impact in the real economy. And yes, you also mentioned the greener way of producing cement. But if you invest into a Nestle, a Novartis, and lead a dialogue with them to improve their overall production processes, this wouldn't qualify under your taxonomy as a green invest or as a sustainable investment.
The taxonomy does not rank or qualify investment. It basically qualifies activities. It says whether activities of companies of whatever organization are in line with the taxonomy goals or not, which are environmental goals, but also social, do no harm principles and whatever. The question then about any kind of company, Nestle or whatever, is then what is the portfolio of the activities of that company? What does it include? You rarely have companies which are purely green or purely brown. A lot is a mix. And then the question, of course, is this company making efforts to move from the one to the other? And that's what you talked about. That's then also engagement. This is not something which is regulated done by the taxonomy. These are other types of rules in terms of how do investors engage with the companies, how do we send the right signals then to investors. It's again labels, standards, bonds, whatever. So, but the taxonomy, in a sense, helps as a basic language, as a basic set of information which you can use in all of these things, because it helps the investment manager in the dialogue with that company to say, look, you have a portfolio of activities. Can you explain to me, are they in line with this? Or are they not in line with this? What percentage is in line with it? And why is the rest not in line with it? Because you don't care, because you don't have the money to change it, because you, whatever. I think it helps in this whole process. But of course, it needs more. The taxonomy itself is just the basis for a lot of other things that need to happen along the way.
Yeah, a few comments from my side. I think it lies in the nature of the fact that such reports are seen very critical when they come out. That's normal. People are afraid that lots of reporting, lots of administrative burdens will come to them, which is understandable. And indeed, our members usually come to us and say, yeah, now we have to provide an ESG portfolio report, an ESG compliance report, an ESG carbon report, I don't know, whatever kind of engagement report. And does this really save the world? Does this really help the investor? We do not know. The point is, however, that ultimately a taxonomy, and there's a long way to go until we'll have such a taxonomy, might indeed help to bridge the gap between, let's say, international sustainability goals like the Paris Agreement into concrete investment practice. But this is a big gap today, and we need many, many steps in between.
But I think you mentioned an important point. Does it actually have an impact? Does it serve the investor? And many investors also want to have an impact. So one question is definitely also, do sustainable investments that we see today in the market have an impact? And I would like to raise a self-critical question here when it comes to our market study. We were able to show 83% growth, and now count about 717 billion of Swiss francs as sustainably managed assets in Switzerland. Now, what do you think? Do these 717 billion actually have an impact on the real world? What part of it has a concrete impact? Maybe if you reflect your own investment practices, where do you think they have an impact on the world? If I may address this to Swiss Re and maybe also Avadis.
Yeah, sure. I think it first depends how you define impact, right? If you look at pure impact investing versus your 700, I think your 700 also covers ESG integration and so on. So maybe part of the question is, does ESG lead to impact? I think that the way we certainly look at it is, and that's why we've tried to share more of our experience, which is a journey, right? So it's not something that, we said we changed 3 years and don't look back. I think it's a continuous improvement element, which is very, very critical to it as well. But, if you're a company and you're not in those benchmarks, if more and more long-term investors move to those benchmarks, it will probably cause you to pause and say, well, actually, a big part of the investors now is not investing into my company anymore. Why is that? So, am I not disclosing enough? So back to the transparency, or actually are there things I should do more of? And what are those things? So I think this is clearly an impact in the sense that it should lead to a change in companies' approach to it. I think ultimately, as more really long-term investors adopt it, I think my hypothesis is actually you'll see the meaningful difference in the cost of capital for the ones, again, who are not in the best-in-class group anymore. And again, if the first sort of benchmark inclusion topic hasn't really led you to think about it, I think this one clearly will, right? Because that's a clear financial one. On the other hand, is as investors, you need to think about, in climate change, right? Do you invest only into new things, purely? So do you support new products, renewable energy, for example? And do you exclude everything that's in transition, or do you actually want to do, multiple sleeves, right? So as I think we do, so we do invest in green bonds as per the green bond principles. We do invest into renewable infrastructure again, which I think is badly needed in terms of the energy transition. But we also have, commitment to help companies get there. So back to the taxonomy, I think you answered it very well, right? The taxonomy helps you assess the company, but it doesn't make the decision for you. At what point do you divest, invest? And I think each investor has to be very mindful of that.
Mm-hmm. Claudia, how do you aim to have impact with your sustainable investment practices?
I think, like this, I can only agree, it's a journey. You start with little steps, the little steps become bigger. So at Avadis, the first step was, of course, like with our internally in managed assets, like with the real estate portfolio. What we did there is to think about what is sustainable in this field. For instance, when we refurbish houses, or we think about how to substitute fossil energy, how to make these houses more energy efficient. And on the other space, like with the more traditional asset as bonds and equity, we were thinking how to best integrate with the best in class, how to have our managers have an impact, and also with exclusion. So we were at the very first exclusion criteria, which is the controversial weapons. And of course, we implemented that. We also had to think about how would this will impact tracking error on passive investments. So the inclusions we don't have a big impact, but we are currently investigating if we switch to carbon reduction portfolios in these equity portfolios, what would be acceptable for the investors. We are not just a single investor, but we have hundreds of investors behind, and we are an investment foundation, so they can vote. So there is no solution one fits all, but we have to find a solution that is where basically everyone is happy. So to find like solutions that can have an impact and the investors still feel happy. And one important actor we also have to take into consideration is investment consultants. So a lot of our clients work with investment consultants, and they rely, or the clients rely on them. And if they don't approve of what we do, we won't have these investors any longer.
I have a somewhat difficult position here because you are both asset owners, you help your clients, you educate them, you consult them. But if I look at the growth rates of sustainable assets, 50, 60, 80%, more than 700 billion in Switzerland, we have roughly 2.2 trillion, 2,200 billion managed, and whereof 700 is, according to your numbers, managed according to sustainability criteria. I'm a little bit skeptical. Do we just have a kind of a ESG overlay right now? How much of it is new money? How much is simply old wine in new skins? Do we really have a new skin, or did we just paint the skin in another color? Green, for instance. So there's questions, and all those sustainable money is based on internal scoring systems of the bigger asset managers, usually insurance companies, banks, and asset managers. And here you must have a deeper look what's really behind. And this is a reason why we welcome, actually, we embrace a common taxonomy going forward, because this helps reducing costs for investors too. So far we have so many different scoring systems, taxonomies within each and every company, which makes it very difficult for investors to find the right ones.
You rightly pointed out that there are many different approaches behind these sustainable investments, and I would want to challenge if the taxonomy is really the right tool to assess the quality of all these forms of sustainable investing. What do you think of starting to assess the quality of the process of sustainable investing? Do we need an assessment scheme and maybe a label for a good sustainable asset management process?
Of course we do. I mean, you asked, I am a Swiss representative, and I'm quite often in Brussels, and usually from a third country, so to speak, we often have some problems to simply accept what's coming from Brussels, and we always say in Switzerland everything is different, we work there different, our DNA is different, we have a more liberal approach, the usual statements we hear. But we would all agree that to have the right process in place would probably, from a risk point of view, the better solution going forward. The question is how much pressure we have to give in order to set some pillars in order to get the process right. And how much voluntary approach is possible here, and how much time do we have to really come up, to really think about this before we have to take over the Brussels regime again, not for the first time.
Any other comments on this one? Okay.
We had the discussion. Sven knows what I'm talking about, of course.
Yeah, I would say not one approach fits all, right? And I think it comes back to your comment, right, about large and smaller companies, about institutional versus retail investors. I think that there is probably primarily on the retail side a lot of interest to invest into more Paris-aligned portfolios, green portfolios, but a lack of transparency whether what they get is really what they receive. So, everything that's in the action plan that's been put in place, I think, is very helpful. I think for institutionals who have a lot more resources, I think they have a lot more of a burden to think about really what they want to achieve. And I think, they can play on many sleeves in sustainability. So not just on the investments that affect the taxonomy, but generally think about climate risk assessment, which with natural hazard will impact all companies which have value chain distributed over many locations, independently if they're one of the sectors directly impacted as well, right?
And I would say maybe not just on climate change as well. We also know all these problems are interlinked. And after all, we talk about ESG when we talk about sustainability. Before I hand over to you for questions, I would want to discuss one little thing. The Paris Agreement says that financial flows should be aligned to the Paris goals. What are flows to you? I mean, we're sitting here and most of what we debate is related to secondary investments on financial markets. Where do we talk about flows, about new financing for companies? Like the startups we heard earlier in the afternoon. You mentioned banking in one side sentence. I mean, does the EU also cover lending activities, for example?
It has been integrated in the banking framework in the sense that it's part of the supervision. It's part of what banks need to consider as well. There was a discussion even in the European Parliament whether prudential requirements, that mean capital requirements, should be based also on these considerations. That was not agreed, but you can tell already from that ideas like that come up that there's a lot of emphasis and there's a lot of interest also for these areas to look at that. And I think the pressure, if anything, there as well will grow on banks to take these things into consideration. They will have to explain why they lend, where they lend to. Does this make sense? Is this taking the risks into account, just like the institutional investors that may be paused by the investments that are financed through bank lending? And I think the kind of transparency requirements also apply here.
But you would say what is happening in secondary markets is also considered a financial flow?
Well, we're talking about green bonds that help the transition. We're talking about companies getting financing from the market specifically to finance the transition to greener production methods. So I think, yes, this plays an important role as well. But all of this, of course, has to be seen in conjunction. I mean, as I said, the numbers are gigantic, 170-something to more than 200 billion a year. That's market-based, that is coming from banks, that is coming from public sources, of course, as well. Horizon 2020 was mentioned in the EU, which is our big research program. We have an European Investment Fund that is putting money into these kinds of things. Everything has to be mobilized to be able to do that. It's not just one element that will do the trick.
And maybe also we spoke about public markets, but there is also a role as for private equity, private debt, private markets in general that can support sustainable activity.
Definitely private equity markets are important, as you could also see in our last market study. I would now want to hand over to you to bring up your questions to the panel. And I start with Eric Boremans here to the right in the front. You can have mine.
A question for Mr. Gentner. On the sustainability benchmarks, I understand that it also comes with a requirement for those low carbon benchmarks to exclude companies involved in controversial weapons under a do no harm principle, if that is correct. And so if that is correct, would there be room for expanding that requirement, not only to low carbon benchmarks, but to all benchmarks, given that controversial weapons, anti-personnel landmine, cluster ammunitions, and so on and so forth are banned by international conventions signed by most European countries, and what's more, in a number of countries, it's even forbidden to finance those activities directly or indirectly. So why keeping those companies eligible to conventional benchmarks in the first place? Isn't that the elephant in the room that we should all be able to agree upon because it's such a low-hanging fruit?
Well, it's correct that basically in the benchmark regulation, but for example also in the taxonomy, it's not just about the green or other goals. It's also the question of, do I actually not do any harm with this activity? So it's no good to produce windmills with child labor, or I don't know, other examples like that. So yes, that is part of the regulation. The regulation, of course, in this instance is mostly focused on climate-related issues. So in that sense, we cannot do everything everywhere. I mean, there are, of course, also sectoral initiatives to regulate these kinds of activities that you talked about. We just concluded the negotiations on the benchmark regulation. I don't think we'll reopen it right away. I agree with you about the importance of this, but at the moment we were very much focused on, say, the green aspects, while not forgetting that we cannot just promote green, climate-friendly activities independent of how they're conducted. And as I said, that's also an important part of the taxonomy, that always this test also applies.
Hi, my name is Nikolai Vavilov. I'm here as a private citizen. I wanted to ask a question to Mr. Fuchs and Mr. Gentner. How do you make sure that the taxonomy makes a better transparency that leads to a more meaningful and genuine information, and doesn't not force companies and investors to increase money to actually? Sorry, I'm just going to wait my questions. In reporting and compliance instead of risk management and actual sustainable capital expenditures? And the follow-up question is, how do you make sure such taxonomy can adapt quick enough to new strategic sustainable investment targets, goals, and considerations?
So how do we make sure this doesn't just lead to more whatever paperwork and no real-world change? As I said, I mean, the basis is we're identifying activities that are in line with certain goals. And what we expect is, and what we will also require is, that companies disclose then what kind of activities they conduct, and are they in line or are they not. And this information, I don't think this is paperwork, useless paperwork, but this is relevant information for investment decisions by financial market participants, who can then on this basis better decide, where do I want to put my money? How do I engage with companies? What do I want to achieve? Are they on the right path and all that? So I don't think this will distract from useful other activities, but it will add important information that at the moment is missing in a more standardized format. And sorry, what was the second part of the question?
How do you make sure that the taxonomy adapt quickly enough?
Oh, the adaptation, yes, exactly. Well, of course, this has to be a living animal. Technology changes, so we will have different technologies, new technologies available over time. Regulatory requirements will change. I mean, the most likely scenario is that requirements will become tighter and tighter when it comes to climate friendliness of activities and all that. And of course, the taxonomy will have to adapt along these considerations. Political changes you can see also in particular of the last few years. So we have now this first report, which is limited to climate mitigation and climate adaptation. The taxonomy will then also be extended to other things, water, forestry, whatever. But on top of that, we are creating a platform, we call it, within the EU, which will, in a sense, permanently take care of this taxonomy, which involves member states, experts, Commission, and will allow the Commission through more technical legislation keep this taxonomy up to date in terms of technology available, up to date in terms of regulatory requirements, in terms of the political direction. Yes, of course, it has to be adapted.
Maybe one additional comment. It has been mentioned a couple of times. It is a EU taxonomy, and we are not really in the position to shape this taxonomy from a Swiss point of view. Nonetheless, and that's a Swiss approach, that's also the job of an association, we follow those issues very, very carefully, because for us they have a kind of a weak signal indication. There's no way around in the long term, and there's many good elements, but Switzerland is too small to come up with an own taxonomy, and for the reasons I mentioned before, we look at those things. They do not the adaptation will not have to be done within a few days. It's a process, it's a journey. And again, for us, this is weak signal indication in Brussels, but we take those issues very seriously, and we try to inform our members accordingly and on time.
Kirsten Dunlop, EAT Climate Geek. I'm actually hoping it's a strong signal, but my question was a reflection and a question, in fact, exactly on your point. It's not surprising that the taxonomy has 1%. If we had 90% of our economy in sustainable things, we wouldn't be in the situation we're in. So my question is specifically the Swiss vision for finance, because I think there is a particularly interesting dialogue, but I'm missing a sense of the Swiss character. If you said the brand for Swiss finance, its qualities, if you were here as branding professionals and were talking about what its qualities and characteristics are, you used the word liberal. Is there an opportunity, or what might be a Swiss vision in a context of profound economic and industrial change for what an asset management and investment process and strategy might be that has some of the other characteristics of the Swiss brand? That may be, almost a quality mark for how to go about this. But I would be particularly interested to understand, as an industry and as a nation, what is your sense of your own vision for the role Switzerland might play?
It's a very valid question, and indeed, Switzerland can only survive by offering quality products outside Switzerland. Otherwise, we cannot keep our economy sustainable. That is clear. It goes via quality. That's why we have to come up with a vision. And the key challenge for us is indeed the heterogeneity of the financial services industry. We know that. We try to work as closely as possible with banks and insurance companies, because ultimately we know that we are in the financial services sector. We cannot come up with a known taxonomy for banks, insurance companies and asset managers, and that's why we have to build the roof, and that's why we work together with sustainable finance, Swiss Sustainable Finance and other associations. This is an absolute key element. I give you one example, and some of you might have heard that before. When I say that financing the social security, financing the infrastructure is a key challenge in many countries, China, Brazil, others. Of course, you need banks in order to make sure that the whole thing is financed. Of course, you need insurance companies to take the risks, but you also need asset managers to bring together demand and supply. And that's why we have to come up as Switzerland, as a country, with a vision how we could offer those solutions in order to address those challenges abroad. Fair point.
And if I may add, of course, the vision of Swiss Sustainable Finance is to create a fully sustainable Swiss financial centre. And I think there are many people in the room sharing this vision and already working on it. But I would like to take one or two more questions. There was one back there, Miss Silvia, and then to the left as well. Just there.
Thank you very much. Sylvia Ruprecht from the Federal Office for the Environment, working in climate policy. So thank you very much for all your interesting discussion and thoughts. So I wanted to follow up on the impact. You said on the disclosure regulations, investors and financial product providers will have to show the sustainability or climate impact. And we heard before that it's not that easy how to do that. Do you provide guidance on also how to make it comparable for and how and in what time frame? And my second question is, you said the financial regulations, they go along with the regulations in the real economy in the EU. So would you also require your investor community to step up and engage with policymakers on the real economy laws or not?
So how do we make sure that the requirements that we have in this transparency regulation will also be kind of broken down and in terms of the impact, which is not easy? Yes, there will be, I don't want to become too technical, but we call this level 1 and level 2. There will be more technical rules on indices and the data that can be or should be used, which will be elaborated by the European supervisory authorities. They've been mandated within the legislative process to come up with these things within the next 1.5 years or so. We still have to wait until the text is finally published. It's agreed, but it has to go through a certain process to be published in the official journal of the European Union. But once this has happened, the work will also start at a more technical level to come to grips with that. And again, it has been said several times, this is a journey, it's a process. We want that as much as possible is disclosed, quantitative, qualitative. We know that not everything is there. This in itself, this regulation will create pressure that more information is provided. We will help by trying to set more standards, give guidance on how to do this. But of course, it will develop over time. Not everything is there immediately. And then the engagement of the financial sector with the rules on the real economy, of course, I think everyone needs to be involved in this. I mean, it's a continuous process. You see now, I mean, as I said in the beginning, the European Council, the meeting of the heads of state and government in the European Union, apart from discussing all these incredibly important personnel decisions, will also talk about these kinds of goals again. I mean, we had a discussion last year in the car sector, emission goals. I mean, in a sense, you have a rolling program of looking at these things again, because quite simply the circumstances are becoming more and more pressing. And I think everyone needs to be involved in these debates to push it along.
So I think we have one more question there at the back, and then we have to wrap up.
Thank you, Sabine. My name is Carmine Orlecchio from OLZ, an asset management company. I appreciate very much the question of Mrs. Dunlop, and going in this direction and maybe more concrete, I have a question for Mr. Fuchs. What is going to do SFAMA concrete around the theme of taxonomy, benchmarking and reporting? Is there a plan? Is there a deadline? Is there a discussion in your agenda? Thank you.
There is no concrete deadline. There is indeed a plan. We discussed that with Mr. Maurer, actually. And for him, it's clear that whenever possible, we would like to take the voluntary approach. That said, it is in the responsibility of the industry, namely the insurance, namely the respective associations, banking association, insurance association, and SFAMA, to come up with proposals, to come up with guidance, to come up with ideas what can be done, so that we are ready, a kind of a bottom-up approach. And time-wise, if you want to give me a rough indication, we're talking about probably time period 2 years or something like that. It will not be months, it will not be more. And again, we have to follow closely what's going on in Brussels, and this kind of discussions in Brussels will, whether we like it or not, set the pillars for our work as well. So to give you an overall timeline, 2 years from now, then we have to have something, otherwise we wouldn't have done our job.
So 2 years still needs some patience. In order to not stretch your attention too much and also to come to a conclusion slowly, I would want to call on you to help me and thank the panelists for their contribution. I think they provided interesting insights, and we know we still have a journey ahead, but the Europe sets the pace and we will also have to move, that's for sure. Thank you very much for joining me here and giving your insights.